Tax law forms the foundation of personal and business financial planning because taxes directly affect income, investment returns, wealth accumulation, retirement planning, and estate transfer strategies. Financial planners must understand both fundamental tax principles and current tax regulations to provide effective advice and help clients achieve financial objectives efficiently. Tax systems are designed to generate government revenue while influencing economic behavior through deductions, credits, exemptions, and preferential tax treatments. Because tax laws evolve over time in response to economic, political, and social factors, planners must remain informed about legislative changes that affect financial planning strategies. A strong understanding of tax law enables more effective decision-making and long-term financial management. Fundamental tax law is based on several key concepts that determine how income and transactions are taxed. Taxpayers are generally subject to taxation based on income received from employment, business activities, investments, retirement distributions, and other sources. The Internal Revenue Code establishes rules governing income recognition, deductions, credits, filing requirements, and tax calculations. Tax liability is influenced by factors such as filing status, taxable income, dependency status, and eligibility for various tax benefits. Financial planners use these principles to evaluate financial decisions and identify opportunities to improve tax efficiency. Understanding the legal framework helps ensure compliance while supporting broader financial planning objectives. An important feature of the tax system is the distinction between deductions, exclusions, exemptions, and tax credits. Deductions reduce taxable income, thereby lowering the amount subject to taxation. Exclusions remove certain types of income from taxation altogether. Tax credits directly reduce tax liability on a dollar-for-dollar basis and often provide greater benefits than deductions of equal value. Financial planners evaluate available deductions and credits when developing tax-efficient strategies for clients. Effective use of these provisions can significantly reduce tax burdens and improve after-tax financial outcomes. Understanding how various tax benefits interact within the broader tax system is essential for comprehensive financial planning. Tax rates and tax structures play a significant role in determining overall tax liability. The federal income tax system generally applies progressive tax rates, meaning that higher levels of taxable income are taxed at higher marginal rates. Marginal tax rates represent the rate applied to the next dollar of income, while effective tax rates reflect total taxes paid as a percentage of total income. Financial planners frequently analyze both measures when evaluating financial decisions. Tax bracket management, income timing strategies, and deduction planning may help clients optimize after-tax results. Understanding progressive taxation is critical because it influences investment choices, retirement withdrawals, compensation planning, and wealth transfer strategies. Income tax fundamentals begin with identifying gross income, which generally includes compensation, business income, interest, dividends, rental income, capital gains, retirement distributions, and other forms of economic benefit. Certain items may be excluded from taxable income based on specific statutory provisions. After determining gross income, adjustments are applied to calculate adjusted gross income, AGI. AGI serves as an important benchmark because eligibility for various deductions, credits, and tax benefits often depends on this figure. Financial planners analyze income sources carefully because the tax treatment of different types of income can vary substantially and significantly affect overall financial outcomes. The calculation of taxable income involves subtracting allowable deductions from adjusted gross income. Taxpayers may claim either standard deductions or itemized deductions, depending on which option provides greater tax benefits. Itemized deductions may include qualifying expenses related to mortgage interest, charitable contributions, medical expenses, and certain taxes. Once taxable income is determined, applicable tax rates are applied to calculate preliminary tax liability. Tax credits are then used to reduce the amount owed. Financial planners often model alternative scenarios to evaluate the impact of deductions and credits, helping clients make informed decisions regarding spending, saving, investing, and charitable giving strategies. Capital gains taxation is an important component of income tax planning because investment decisions frequently generate taxable gains or losses. Capital gains arise when assets are sold for more than their cost basis, while capital losses occur when assets are sold at a loss. Tax treatment often depends on the holding period of the investment, with long-term gains frequently receiving more favorable tax rates than short-term gains. Financial planners use tax loss harvesting, asset location, and gain deferral strategies to improve after-tax investment performance. Understanding capital gains taxation helps clients preserve more of their investment returns and supports efficient portfolio management practices. Fundamental tax law and income tax calculations are integral to virtually every area of financial planning. Taxes influence investment returns, retirement income, education funding, insurance strategies, estate planning, and business decisions. Effective financial planning requires more than simply calculating tax liability. It involves understanding how tax rules affect long-term financial outcomes and identifying opportunities to improve efficiency. Financial planners integrate tax analysis into broader planning recommendations to help clients maximize after-tax wealth accumulation while maintaining compliance with applicable laws. By understanding current tax regulations, income tax fundamentals, and calculation methodologies, clients can make more informed financial decisions and improve their prospects for long-term financial success.